Today I am going to explain you the rules of debit and credit based on traditional approach. And before I explain the rules, you must understand the classification in this method. The classification of accounts is personal accounts and impersonal accounts. Now, what are the personal accounts? Personal accounts could be for real persons, for example, Ram account, and for artificial persons, for example, then in the names of firms, for example, Ramnath and Company account. So it is which account? It is artificial persons account. It could be a representative account, for example, salaries outstanding. So this account represents the salaries unpaid to the staff. So this could be salaries outstanding. This is representative kind of an account. Okay. Now impersonal accounts could be of two types. Real accounts. Now real accounts means accounts of assets like building, machinery, cash, all the assets we own, they are called real accounts. And then in an impersonal account, the other category is nominal account. Nominal accounts. Now, these accounts actually represent all our expense and losses account. For example, purchase account again is a expense, traveling account, conveyance account, telephone account, all these are expenses account. For example, loss by fire again is a loss account. All these are nominal accounts. And the other nominal account is that relates to our incomes, revenues. Okay, this is incomes and gains. For example, sales account, discount received account, rent received account, all these are incomes accounts or gains account. Now for all these accounts we have different rules. Now for example, personal accounts, our rule is very simple. Debit the receiver, credit the giver. It's very clear. For personal accounts, rule is debit the receiver and credit the giver. That's very simple to understand. And for real accounts the rule is debit what comes in and credit what goes out. And the rule for nominal accounts is for expenses and losses, the rule is debit all expenses and losses, credit all incomes and gains. I think rules are very clear. Now based on these rules, I will explain you certain journal entries. For example, a businessman Ram starts his business with say rupees 50,000. He introduces 50,000 cash in the business. Now if we analyze this transaction, it has two aspects. One, that cash has come in the business. So the rule applies debit what comes in. So we will debit cash account. Since Ram has given this money and Ram's account, which is actually the capital account, is a personal account. And the rule for personal accounts is debit the receiver, credit the giver. In this case, Ram is giver. Hence, we will credit Ram's account. Now, what will be our journal entry for this? Debit cash account and credit Ram's account, which is actually the capital account. So our journal entry for this purpose will be cash account debited to capital account. Okay. Now, second, purchased goods for cash. In this case, if we analyze this transaction, purchases represents a nominal account. It's an expense for the business. And the rule for nominal accounts is debit all expenses. Hence, we will debit the purchase account. Okay? And cash account is a real account. Cash has gone out. And what is the rule for real accounts? For the real accounts, the rule is debit what comes in, credit what goes out. In this case, cash has gone out. Hence, cash will be credited. The total journal entry will be purchases account debited to cash account. Purchases account debited to cash account. Now, third entry can be purchase of, we can say purchase machinery for 50,000 on credit from Shyam. Okay. Now, if we analyze this entry, machinery account is a real account. So, machinery is coming in. So, machinery will be debited. And since we have bought this machinery on credit from Shyam, right? And Shyam is a personal account. He is giving us. So, the rule for personal accounts is debit the receiver, credit the giver. In this case, hence, Shyam will be credited. The journal entry will be machinery account debited to Shyam account. Machinery account debited to Shyam account. Now, the next entry can be cash deposited in bank. Now, if we analyze this transaction, cash account is a real account. If it is increasing, it will be debited. Okay? But if it is decreasing, then it will be credited. In this case, we are depositing the cash in the bank. So, cash is decreasing. For real accounts, the rule is debit what comes in, credit what goes out. Hence, cash will be credited. And bank account, it's a personal account. You will be thinking how personal it can be a personal account, because this account basically represents the cash held by us with our bankers. Hence, it is a personal account. And the rule for personal account is debit the receiver, credit the giver. In this case, bank is receiver. So, bank account will be debited and cash account will be credited. So, the entry is bank account debited to cash account. Bank account debited to cash account. Okay. Now, next entry for us is paid salaries through cash. Now, salaries. Salaries is a nominal account and it's an expense. So, rule for expenses is debit all expenses. So, salary account will be debited. And since we have paid this salary through cash, and cash is a real account and cash is going out, rule is debit what comes in, credit what goes out. In this case, cash is going out, hence cash will be credited. So, our journal entry in this case will be salary account debited to cash. Salary account debited to cash account. Now, next, another entry could be charge depreciation on machinery ₹5,000. Now, what is depreciation? Depreciation is reduction in the value of any fixed asset due to usage, etc. So, basically, it's an expense for the firm. Now, when we charge depreciation on machinery, it involves what? It's an expense. So, depreciation is is a nominal account, it's an expense, so depreciation account will be debited. But at the same time, the real asset, which is machinery, it is reducing. So our rule for real accounts is debit what comes in, credit what goes out. So machinery is reducing by whatever the amount we are charging as depreciation. Hence the entry will be depreciation account debit to machinery account. Depreciation account debited to machinery account. Next entry is we sell goods for rupees 20,000 in cash. In this case, the two accounts involved are cash and sales. Cash, as you know, is a real account, and when we have sold goods on cash, cash will come in, hence cash account will be debited. Now sales account, it's a nominal account, it's our income, hence rule for this is debit all expenses and credit all incomes and gains. So sales account will be credited. So our journal entry in this case will be cash account debited to sales account. Cash account debited to sales account. I hope the rules of debit and credit are very clear to you. In the next lecture, I will make more entries make more journal entries. Thank you.